Royse of the Royse Law Firm in Palo Alto, and today we have with us Joe Marshall, who's going to give us a presentation on finance aspects for startup companies. This presentation will include basic accounting and tax issues, valuation, funding, and financing terms. Joe has been a CFO for over 25 years in all aspects of finance, treasury, IT, and HR for consumer products and technology. His experience includes business development planning, financial and cash flow modeling and reporting, contract negotiations, system integration and implementation, raising private equity money, private debt instruments, IPO registration, and SEC compliance reporting. And he has made significant contributions to many companies ranging from startups to $100 million public companies. Joe has a particular expertise in food service companies as well. So I want to remind everybody that this webinar is being recorded. You'll be able to find a copy, a recording, a video recording on the Royse Law YouTube site as well as on Royse University under industry videos. You'll also be able to download the audio in the Apple Podcast Store. And the slides will be available from Joe directly or from me if you want to email us after the presentation. This is one of a series of webinars that we do here at Royse Law Firm. Our next one coming up is on April 7th. It is on government grants, how to get money from the government for your company. On April 30, we have a presentation on Startup Fundraising 101, the basics of fundraising for startup companies. And finally, I want to remind everybody that May 11th is our day-long Agriculture Technology Conference in Mountain View at the Computer History Museum. And ticket prices go up after tomorrow, so make sure that you go to www.svagtech.org and get your ticket for the AgTech Conference on May 11th in Mountain View. So with that, as Joe gives his presentation, you may have questions. You'll notice in the right-hand corner of your screen there's a dialog box. You can go ahead and type your questions in. We'll take them throughout or possibly at the end of the presentation. And if anybody wants to follow up with Joe directly, we will be able to do that offline. I'll forward his contact information to you. But during the presentation, just note that you can type us questions in the dialog box. And with that, Joe, I'm going to turn it over to you and let you take it away.
Great. Thank you, Roger. Thank you all for attending. And as Roger had outlined, what I'm going to be talking about is a lot of topics that I usually get into with my clients. I'm not going to get into a lot of details on any one of them. These are all fairly general issues that I'm going to be talking about, and we'll go from there. So why don't we start? So let's start with what kind of entity makes the most sense for your company, for you and your company. There's basically two types of entities. There's a C Corp and then a flow-through entity, which is usually an LLC or an S Corp. And both of them have advantages and disadvantages. And you have to make sure that when you create your entity that you understand what those are for. And as a general understanding, the flow-through entity is one that's used for a closely held company. You may raise some money from your family or angels, has a few owners, and if you can manage a business like that in that kind of a ownership structure, then an S Corp would probably be really good for you in terms of tax advantages later on. However, if you know right out of the chute that you're going to be raising venture capital money and you want to go public and you want to have maybe some foreign investors in there, then you'll have to go with a C corporation. If you're really not sure, then I think it's best to go with a flow-through entity first, because it's easy to change from a flow-through entity like an S Corp to a C Corp. It's more difficult to change from a C Corp to an S Corp. And I've had clients that have C Corps and they're closely held entities. They want to sell, and they get hit with the double taxation rule, and that's a killer for these families. So really, just make sure that you understand the tax rules. And Working with a firm like Rogers will be able to help you define that and really take you through the steps on what you're looking for as you initially incorporate. Okay. So if you're out to raise money, there's a couple things that you're going to want to understand and do first. One is your cap table, your capitalization table. That defines the ownership. And a cap table is very easy when you start off. It's you as a founder or a couple people, and you own a certain percentage of shares. And then as you start adding new rounds and new equity rounds, you want to add those to your cap table. And there's a fully diluted cap table and an undiluted. A fully diluted cap table means that it's acting as if everything, all your options, all your shares have been exercised, and it shows you what your ownership effect is once everything's been exercised. And undiluted is only the shares that have been exercised and are outstanding at that time. So you want to make sure that you look at both of them. And so that would include, you know, on fully diluted, you want to include all your stock option plans, any warrants that you might have outstanding, and everything. The other thing that I want to talk about, I have an example of a cap table on another slide, but I want to go to a term sheet and let you understand that it's not just about valuation when you're understanding terms. There's terms on a term sheet that can affect the overall return to the common shareholders. And a couple of those are liquidation preference and anti-dilution rights, maybe most favored nation rights, things like that. Terms that affect the ownership and the right of the existing investors to either get their money first or to get more pro rata share of money as future rounds happen. And I have an example of what that would look like next too. And then, you know, you want to make sure that you create your board of directors. And when you just start out, if you're just starting out, that's not as important. But certainly when you do your first fundraising, you should have a board. And a board can be defined by the first Series A round. A typical board would have 5 members. You'd have 2 common shareholder members. You'd have 2 of the new equity members, and then a 5th member that would be mutually agreed upon through the 2 other parties, both the common and the preferred shareholders. And that could be somebody who's got extensive industry experience. So why don't we go to the next slide. So this is an example of a cap table. And what you want to do is you don't need to put valuations or values on a cap table. It only is looking at ownership. So you want to make sure that you look at, you've entitled all of your owners and you put them in different categories. Like here we have the common stock, the Series A, Series B, and then there's a total. And there's a stock option pool down there, and this is a fully diluted cap table, so it takes into account all the stock options if they were fully executed. So you can see that, you know, over time, the dilution of the founders goes from 50% each down to 26%, and you can see the Series A investors what they gotten at the end, and the stock option pool too. So it's just important to make sure that you keep the separate ones, and usually, if there's a different price that you have on an offering, that would make that differentiation on the columns for you. Okay, let's go to the next one. So this is a true example of a company I worked with about how a liquidation preference can affect your payout as a common shareholder. And I was doing some investment work at this time, and we looked at this company, and we felt, I was in investment A there, that the pre-money valuation should have been $7.5 million. The investment was $2.5 million. So the posted money was $10 million, so that gave the investor a 25% ownership stake in the company. They had a 1x liquidation preference. Versus investor B, where the owner of the company said, that's too low of a valuation. I really think I should be valued at $15 million pre-money, and I don't want to give away as much ownership stock. So they found an investor, and the same kind of thing: $15 million pre-money, $2.5 million. Post money was $17.5 million. The investor ownership was 14%, but they had a 3x liquidation preference. And then 2 years later, the company sold for $25 million. So below that, it shows you how the money kind of flowed through. So an investor A, or investment A, with a one-time liquidation, that means that liquidation preference is paid before anything else is distributed. So you have the $2.5 million payout and the liquidation preference. Then the funds remaining to distribute are $22,500,000. The investor gets that 25% of that, and then the owner or the common shareholders get the $16.875 million. And then in investment B, you can see the difference where it's a 3 times liquidation preference. The investor got $7.5 million before any sharing. The funds to distribute were $17.5 million. The investor got 14.3% of that, or $2.5 million. And so the owner, the common shareholders, received $15 million. So even though the investor, the point I'm trying to make in this is even though the investor in the investment A had a, well, in the investment B, I should say, even though that investor had a lower ownership percentage with that liquidation preference, they ended up getting $10 million versus in investment A, they got $8.125 million. So it's just want to make sure that you don't, it's just not about the value. Okay. So now that you've got a company, you've got some money, you need to start recording transactions. And when you set up an accounting system, the system that virtually everybody uses to begin with is QuickBooks. And it's a very flexible system. It's easy to use. It's easy to set up. It's inexpensive. There's a lot of different models to choose from. You can buy a simple model for $200, or you can buy an enterprise system that has full manufacturing inventory capability, and that's, you know, for 5 users, you can get that for a couple $1,000s. As you grow a business, those kind of some problems with QuickBooks become a little bit more apparent. They're not very good in reporting. There's really not very good foreign currency transactions, and their multi-warehousing inventory issues are pretty, or capabilities are pretty weak. So, you know, I'm not saying that you can't run a business on QuickBooks. I've got a client that's doing, will do probably over $80 million this year. They're a manufacturing company. They run QuickBooks. They have a very simple one product, one warehouse kind of a model, and they're able to use QuickBooks. So you know, there's no kind of dollar amount where you need to automatically say QuickBooks doesn't work anymore, but it's just really more about the features. So if you look to migrate from QuickBooks to a full ERP system, then, you know, because you're not happy with the reporting, because you're not happy with the costing and everything, then you'll need to migrate. And most of the migration right now is happening on cloud-based systems. And, you know, examples of systems that people are using are NetSuite and Great Plains. And then there's also a lot of several industry-specific systems. Like I work with a bakery, and they have a baking-specific system that they use. You can be a distributor and have a distributor system. Both these systems provide much better information. You know, you can really get into some real good costing systems with these. If you have a company that uses process accounting, process flow accounting, where like a bakery, you start with 1,000 pounds of ingredients, and you end up with a certain number of cases. You have yield factors, you have waste factors, those kind of things. These systems can really nail those down. You can't really do that in QuickBooks. Pricing is usually based on customization and the number of users that you use. I've seen kind of NetSuite systems or Great Plains. If you've got 15 to 20 users, kind of some minimal customization, you know, you can be spending $5,000 to $10,000 a month. If you're going to be doing a lot of customization, or if you just can't find the one system that works for you, then you may want to buy it, host it. You have the source code, you can customize it, and you can use that, you know, going forward. Okay. Okay, so now that you've got your accounting system, then you need to start creating reports. And there's the standard monthly reports that everybody kind of knows and understands. They may be required by your board of directors. If you've gotten some loans from banks, banks may require you to issue those to them on a monthly basis. These are your typical income statement, balance sheet, and cash flow. They can be compared to a budget. They can be compared to a prior year. These are what I consider backward-looking. Transactions have already happened. There's not a lot of indications of what's going to be happening next month or the next 6 months of these reports. It's more of a snapshot, and this is what's happened in the past. And then, so in addition to your standard monthly reports, you want to look at what I call forward-looking reports. And each company has key indicators that that kind of drive their business and are the most important drivers of the business. You should be identifying those key indicators and working with those to create a full reporting package that can also give you indications of what's going to be happening down the road. You're incorporating things like if you're a retailer, if you sell products to retailers. Do I have any new stores? What's my sell-through at that retailer? Have I lost any retailers? Things like that give you more information than just financial information. A lot of times you hear the word business intelligence dashboards. That's where these would be recorded in. And if you use QuickBooks, QuickBooks doesn't have there are third-party software packages that you can use for dashboards or business intelligence. You also use Excel. For these, Excel has some great dashboard samples or dashboard templates that you can use. And if you have a full ERP system, they usually have a package or a software segment for you to use like that. And I've got a couple of dashboard examples here. Why don't you go to the next? Okay. Was there another one before that, or is it? Didn't come up? Okay, well, let me look at the next one then. So this is an example of a dashboard, and this is done through Excel. The other example I had that for some reason didn't come up is more graphical. It was all graphs versus this is more of a listing of things. But there's a lot of data that you can have on here, and what you want a dashboard to do, and these informations is you can zero in on any of these customers or data points or anything that you want to look at. And dashboards can be customized for each department. Like a sales department can have a certain dashboard that deals with sales information. An operations department can have its own operations dashboard. That might have more information on production metrics. What's your yields been? Have you been fulfilling orders? Have you had any stock outs? Have you had any lost sales? Things like that, things that you want to watch in those instances. So they're very informative. You can make them really really neat and pretty, and they're something that I think every company should have and use. Okay, why don't you go to the next one? So let's talk about budgeting and forecasting. I'm a real strong believer that you should have an annual budget. An annual budget is a roadmap for the company. It will give you a good idea of how what your cash needs are going to be over the next year or 2 years. It can give you some good inflection points when you think you'll need to raise money, and will you do that with equity or with debt. I like to have a very detailed one-year budget, which is by month, by account, and then for years 2 and 3, you can have more of an annual budget. And this budget is usually not changed. You can change it maybe once a year, maybe midpoint of the year, but it's really a look back and seeing what did I think the business was, how is it now, where was I off, how did I compare to it, and understand kind of how the business changed a little. In addition to an annual budget, I always use a rolling forecast. It's a shorter term tool that I use that incorporates more of the actuals, and then from that we can change and see what's going to happen in the next few months. The rolling forecast is something that I use to really drive my cash cash forecasting in the near term. And typically I use rolling forecast to be 3 to 4 months out, no more than that. Otherwise you get into more of your budget. But it can be a very good detailed tool to use to really nail down your cash flow needs and other needs that might come up. Okay. So talk about employee stock plans. We had talked about an employee stock option plan. There's, an employee stock plan is used as a block of stock to allocate to future employees. If you have important future consultants, you can also issue plans for that. These plans should be created. They need to be documented by an attorney, such as Rogers. And you allocate stock based on the job level and performance and et cetera. There's typically a vesting period. A vesting period can be 4 years. Say 25% is vested on the first anniversary. Then the vesting is monthly thereafter. And it's important that you have a defensible valuation for your common stock or your employee stock. And what I mean by that is that years ago, you could take 10% of the preferred stock price and say, okay, that's my common stock price for my options based on it being not having the same kind of class of stock and this and that. It needs to have, now you need to have a valuation done. And the valuation is usually done by an outside valuating firm, appraisal firm, and they'll take everything into account, and they'll give you a common stock option price that you can then issue the stock at. And then, the last thing you want is that you've issued common stock to an employee, you have a sale, the IRS challenges that common stock, and then it creates just a nightmare for you and your employees. So with an outside appraisal firm that's a reputable firm, they can justify this value to the IRS, and it'll usually hold. An appraisal is not cheap. It's probably going to cost you between $5,000 and $10,000. If you're using a larger CPA firm, say in your area that's got these capabilities, they can have a valuation firm as part of their offering, and then maybe you can get a deal with them if they're doing your audit or something too. But it's something that the board will usually require, and it's also a safety net for the board. And there's other plans that you can use that are not employee stock option plans where they can actually exercise and get ownership. And let's say that you're a closely held corporation and you want to provide incentives to your employees that give like stock option-like incentives. Well, there's option plans like the phantom stock plan, which is commonly used. And what that is that has an arrangement with your employee where they get a certain percentage of the company or a certain number of shares of the company. And if there's a liquidation event, then they would get those shares, the value of those shares in the transaction. You're not giving up any voting rights as a company, so they really are a nice incentive for companies that are more closely held and don't have the say the public kind of look that other companies might have. And the phantom stock plan again should be designed by a company like tax attorney like Roger who can do that. And I know I've worked with Roger on creating a couple of those. Okay, so let's talk about audits. Audits are, what are the triggers for an audit? I mean, why would you need an audit? A lot of time when you get an investment by an institutional investor, you'll need an audit. If you go out with angels or you have family and you may postpone an audit, you might just look at reviewed statements. You start borrowing money from banks, and there could be triggers for audits from a bank loan. If you have any kind of SEC filings that you want to do, you'll have to have audits. If you're looking to get acquired, an acquirer may demand an audit, and your board may say we need to have audited statements. Really, if you plan on any of the above, if you plan to raise institutional or to be acquired or to borrow money, I recommend that you get audited sooner than later. It's very difficult to go to prior years to get audited and get a clean opinion. I've worked with several companies that have been looking to be acquired, or I've worked with couple companies that look to do a merger and a public offering, and they weren't audited in prior years. You know, strangely enough, the one thing that all these audit companies key on is your inventory valuation, and if they can't get an independent third-party valuation of that inventory, then they couldn't come up with a clean opinion for that audit. So I really recommend to get an audit sooner than later. An audit's going to cost you, it's expensive, you know, an audit's going to cost you $25,000 to $40,000 for the year. I mean, if you're starting up and you're a simple company, you know, you may be able to get it for $15,000 to $20,000. But as you grow and you get larger and your business becomes a little bit more complex, maybe you have an international presence, maybe you have subsidiaries, whatever those, then you know, you'll be paying over $40,000 to $50,000 for an annual audit. It's expensive, but it's kind of an insurance policy. Okay, the next thing I wanted to talk about was insurance, and you know, you have to have insurance from day one of the business. The policies that I recommend are the general property liability. You have to have workers' comp, an umbrella coverage that extends your limits on the general property, employment practices, cyber protection, directors and officers. If you have any kind of a board, if you have any kind of a professional officer, you're planning directors and officers. And then key person life. A key person life is usually a requirement from a Series A round or from a banking lending perspective, where they want to be named as the additional insured for that. Other policies that you may want to look at are your corporate auto policy, product recall, and then there's international supplemental coverages. But you really need to have insurance. And, you know, a lot of companies, you know, another question I ask is, when your employee rents a car, what insurance pack, what do they do with their insurance thing for the automobile, for the rental car? And I had a company that had an issue. An employee rented a car. They thought that their insurance covered the liability. It did cover the rental car liability, but the rental agency charged them for the loss of revenue for that car while it was being fixed, and that was not covered under the corporate auto policy. So, and that turned out to be a couple $1,000s. And so it's pretty expensive. So now they always pick the most, you know, the full liability coverage when they rent cars, and that wouldn't have happened if that. That's just an example. Okay. Then there are compliance issues that you need to be concerned about as you go. And, you know, for payroll compliance, do you register? Everybody has to be registered in the states that they're active. If you have employees in other states, you need to register there. Make sure that you've incorporated all your local and payroll taxes. Do you use an outsourced payroll service like ADP or Paychex? Or do you use your own? I mean, for the companies that I work with, that I manage with QuickBooks, we use QuickBooks Payroll. It's very easy to use. It's easy, well integrated, and it's actually not a bad package. But you have to make sure that you stay in touch with all of your local community and city requirements when you're doing payroll. And then your sales and use tax filings. You know, even if you don't sell to the end user, you may be buying items. You have use tax filings. Just make sure that those are up to date. If you are selling to consumers, or you are the last seller, then you may need to make sure you file all your sales taxes. Then property tax filings. You know, if you have a plant anywhere, you'll need to file that. Make sure that that's kept up to date. And then with new compliance issues with the Affordable Care Act, those are pretty cumbersome. I'm not an expert on that, but there's a lot of requirements that you'll need to follow for that, and depending on the size of your business or where you're at for those. Okay, and then let's talk about international issues. So if your company is selling internationally, there are some entities that you can set up that give you a tax advantage to sell internationally. And you know, I had a client that was doing about $30 million a year in revenue, and I asked them, do you have any international sales? And they said, no, it's just United States and Canada. And it's like, oh, okay, well, you know, Canada is international. So you want to make sure that you separate those out. And initial steps to do that would be to set up a foreign disc corporation. And the foreign disc corporation allows you to reduce the taxes on the products that you sell internationally by taking the gross margin of those products and having a lower tax rate on those than you would on a typical sale of gross margin product. And this needs to be set up by a large CPA firm, a firm that is has these. They manage a lot of these. The firm that I choose has about 200 foreign disc corporations that they've set up, and they manage for different countries around the country. It's a very easy thing to do. There's no kind of transactions. You don't do everything that you do is through journals. There's no paying any payments or doing anything separately. You don't invoice customers separately. It's very easy to do, and it gives you a real good tax advantage. That should be your, you should have that. If you do any foreign international sales, you should have that set up. But if you have to have a more formal presence in the country, let's say that you have to hire somebody in that country, is that actually going to work for you? Then you typically have two choices. You can set up an international office. International office can be set up like as a department on your books. All the admin can be handled from your corporate office. It's the least expensive thing to do. You still have a hire in a different country, so you have to make sure that you've followed all of that country's rules for an employer. For an employee. And every country is different. I've set up companies in Germany, England, Belgium. They've all been different in terms of what your obligations are to that employee. So you need to make sure that you have a good local source. And then if you want to create more of a presence in that country, say you want to do manufacturing in that country, or you had to help, do an R&D, and you have a whole team set up there, then you might look at creating a wholly owned subsidiary. So, of course, it's more expensive than having just a corporate office, but it gives you some advantages that you might have that having a corporate office might not. Maybe there's things that you can do if you set up an office in the EU that gives you EU incentives to sell in the EU. These are consolidated in your books at the end of each period. It's expensive. You have to audit that. Typically, the audit firm will have an audit company they work with in that country, and that would be somebody that they would then have audit that business, and then you would consolidate into yours. So that's pretty much it. I just wanted to kind of hit on kind of the main topics that I look at when I go in to a new client, and that's my email there, joe@management360solutions.com. So
all right. So, Joe, how do we find you? Just at 360 Solutions?
Yeah.
360 Solutions?
Yep.
So I guess I got a couple of questions, because these always come up in startup practice, and you kind of touched on this a little bit. Mm-hmm. But at what point should a company be thinking about putting in place a more formalized process for keeping track of financial information? For example, I see a lot of startups that just keep everything on an Excel sheet. At what point should they go to QuickBooks, to Quicken, and to something even more significant than that, or is that enough?
So, I think they should do it from day one. QuickBooks or Quicken and you can buy a QuickBooks Pro for $200. That's, if you're just doing transactions, that can really help you manage the transactions, keep track of things, and help you with your reports and reconciling accounts and everything. Certainly, if you're going to raise money from anybody outside of yourself, you'll need to, the investor will want to have assurances that their money is being spent the way they were told it was going to be spent. And you can't do that with Excel.
You know, another thing you touched on that comes up all the time is this issue of stock options, because you're right, in the old days when you and I used to do this, it was pretty easy. Everybody got a stock option plan in place right at the beginning. We just used rules of thumb to determine what the option price is, and now they have to get appraisals or valuations. So I'm not seeing very many companies that want to do that early stage, and they're all looking for alternatives. What's your experience with this?
So, again, to me, Roger, it's triggered by do you have what's the level of investment that you have, and how sophisticated are those investors? And if you're, I think if you're going to be raising money from a venture capitalist or some institutional investor, then they're going to demand, as a board member, that you have a formal appraisal done. That's been my experience. Now, if you have angel investors and or if you're just funding the money yourself, the company yourself, then you might be able to get away with some valuation that you use, but again, you're risking it that if you ever get challenged by the IRS, then you're risking that they might come back at you on that.
Going a little further down the track with these companies, there comes a point when a company is going to have to bring in a CFO type person, as opposed to just relying on outside people. And it's always a little bit of a question for these companies, the investors. They want their money to go right into developing product first, it seems, or building the business and doing the finances later. Do you have a view as to how a company can manage that? Because you've convinced me that it's important to keep track of the finances, but how does a cash-strapped, efficient company do that? And when should they have a CFO to manage this?
So hiring a full-time CFO, I think the companies they need to be fully funded, and they need to have, I think, profitability, or have a path to profitability. I think that they can outsource CFO, controller, accounting services, and you can get to be pretty large, and these companies do pretty well. Like, I have several clients where I have anywhere from bookkeepers to accountants to controllers in entities, and they're doing part-time work, project-based, and so it's working out very well for them. And then I come in as a CFO and deal with more higher-level stuff. There's no rule of thumb in terms of an actual dollar amount. It really is, I think, when the activity starts to really generate where a part-time person doesn't make any more sense, and then a full-time person actually is the cost saver then for them.
Okay. Well, I want to thank you for coming in and talking to us about finance for startups. I want to remind everybody that we've got a couple other webinars coming up in April. On April 7th, it's government grants, how to get grants from the government, Department of Defense, Department of Agriculture, etc., federal and state. April 30, Startup Fundraising 101, what you need to know about going out and raising funds. And again, finally, May 11, Computer History Museum, our day-long Ag Tech Conference. A full day of panels, presentations, speed networking events, and pitches. So with that, again, this webinar has been recorded. You can access it on the Royse University website as well as the Royse Law YouTube site. And if you have any further follow-up questions, or if you'd like a copy of the slides, or would like to get in touch with Joe, please feel free to email us at rroyce@rroycelaw.com or at joe@management360solutions.com. Okay, thank you very much.
Thank you.